let's set you up with some of the myths that we're going to talk about today. That
4 myths
that
are out there all the time that even a lot of investors who've been investing for a long time say, oh yeah, I do that all the time. If you do that all the time, it doesn't mean that it's right. It doesn't mean that it's okay. Maybe you're getting away with it. Maybe you don't even realize that you're doing something that you shouldn't be, but you don't need to be. So let's talk about the first one. All right,
Okay.
This is a big one. Have you heard this before? If you're flipping a property, or if you've owned a property for a very long time, that what we can do is, let's say that you've owned the property for 10 years and it's been a rental property for 10 years. In the last year, in year 9, you can move into it and live there for a year and then sell it, and you won't have to pay property or
capital gains.
Capital gains, thank you, on it because you lived in it. So is that true? I have a feeling many of you are going to go, no, it's not true, So what is true? Is it 24 hours?
Because a lot of people also will buy a property, move into it, and they're thinking that they'll move into it for, some people think if you move into it and sleep in it one night, or some people think, well, I got to live there for 6 months, or I got to live there for a year, and if I do that, then I can call it a personal residence. I can qualify for personal residence mortgage, and then I can flip it and not have to pay capital gains. All this kind of stuff, right? So, what is the truth on that? That's our point number 1 that we're going to talk about.
Okay, so let's just get really clear on this. Here's the deal: if you are making money on a property that you are not living in, if you've lived in it and the intent was to buy it as, a principal residence and you've made money on it and the market's gone up, woohoo, congratulations, good for you. But if you buy a secondary property and you don't live in it and you are renting it out or leasing it or flipping it or renovating it to sell or whatever you're doing, and you then sell it, there is a capital gain on that. You pay tax. Listen, if you're paying tax, you're making money. That's a very good thing to pay tax. So do we want to be paying as much tax, like tons of it? No. Do we want to be smart about what we pay and what we don't within the legalities of it? Absolutely. But listen, if you make money on a property that you're not living in, you pay the taxes. I don't care if you slept there in a sleeping bag. I'm not joking. I've heard this one more times. Well, I slept there overnight. I took my sleeping bag. I took my iPad. I watched movies all night. And so now I don't have to pay capital gains. Not true. Tisha, like you said, what was your intention when you bought the property?
And that's really what CRA looks at, right? They look at what was your intention. Was your intention to try to qualify for residential financing, but even though you're an investor? Was your intention to buy and live in that property or to flip it? These are the kinds of things that come into play, because a lot of people come and they say, listen, I want to buy a property, 5% down, live in it for 6 months, do a renovation, flip it, and do this over and over and over again. Okay, so here's the key. If that is your intent, then you can't do it. Yeah. Pretty simple. You can't do that legally. You're going to run into issues if you do that, if that is your intention going in. Now, can you buy a property and, in 6 months your job gets transferred and you have to move and you fix it up and you sell it and you make some money? Absolutely. Your intention was to live in it.
Or this house, our intention
was to buy this and flip it.
We planned to be here for a year, maybe 2. It's a big place, and so we knew, and we were doing a lot of the work ourselves, so we knew it would need, some time. But guess what? We're here 15, 16 years later. But our intention was to buy it and flip it.
So I just want to clarify. Because a lot of people think, well, there's a 6-month rule, or there's a 1-year rule, or there's a 24-hour rule. And we just want to clarify, and this is myth number 1, there is no time frame. There is no rule. Okay? We just want to make that very, very clear. So there is no such thing as a 6-month rule. There's no such thing as a 1-year rule. Okay? So what CRA is looking for to determine whether there's mortgage fraud involved or whether somebody is trying to skip out from paying the taxes they should be paying, they are looking for intention. So if they can prove that your intent was to do a flip from the beginning, if they can prove that your intention was to use it as an investment property, even though you qualified for 5% down, then that's where you're going to run into issues, okay? So we just want everybody to be very clear about that it comes back down to your original intention.
Your residence has become a rental in a year. So you've lived in it for a year.
Yeah, this is a good question.
It's a great question. So here's, and Marie answers it. Yeah, it's happened to us twice.
Yeah.
So what happens is you mark that point in time as a change of use. So it changes in use from being your principal residence to being a rental property. So what do you do at that time? You get appraisals if you want to, paid appraisals. You can have an appraisal done to establish how much the house is worth. So for example, when you move up. So in one property, we moved into it, we bought it for, how much did we buy?
So 76. We bought that property for $219,000. Okay, we bought this property for $219,000. We moved into it with the intention of living in it. We weren't intending to do anything other than that. We moved into it. We paid $219,900 for it.
We lived in
by
it
the way,
for 2
that
years.
was $500 down. But that was a really cool
that
story.
Was
that's an aside.
No money down almost deal.
So we bought it for $219,000. We lived in it for what?
2 years.
2 years. Yeah. 2 years. And then we found this property. This was an acreage. We were looking for an acreage. We're like, wow, we want to buy an acreage, so let's do that. By that time, the property had gone up to, let's say, roughly about $380,000. I don't remember the exact number, but it was worth about $380,000. So what we did is when we moved out, we got appraisers to come in and give us an appraisal valuing the property when we moved out. Now that $219,000 gain from $219,000 up to $380,000, that was tax-free. That's what the gain was while we lived in it. Now, we ended up keeping that property for several years after that, almost 10 years, I think, after that. And, in that period of time, it went from $380,000, I think, to $440,000 or something like that. There was a bit of a gain in that 10-year span. So that gain, we had to pay taxes on, a regular capital gain. But $380,000 down, we didn't have to because we had lived in it in that period of time.
But here's the key.
And we could prove it with an appraisal.
Yeah. Here's the key. You have to be able to prove it. So we did an appraisal. We also printed off some market comparisons from like real estate comparisons, so that we could say like, this is what it was at, and when we came forward with it, here's our proof. Here's what we owe, paid. So you change the use, but at that point of change of use, you do have to mark the value of the property at that time. Now, it could also be less at that time. Mm-hmm. It could also be whatever it might be, but you do have to mark what the value of the property was. So that's a really good question, so thanks for that.
Let's clarify this last myth, this number one myth, okay? There is no set time period, 6-month rule, 1-year rule, when it comes to flipping a property and considering that a personal residence. I'm gonna live in it for 6 months, I'm gonna live in it for 1 year. There is no time frame rule. The rule is, what is your intention from the beginning? Okay. Yeah. Now your intention can change. Remember that. Mm-hmm. But what was your intention at the start? And that's what CRA is going to be.
And if it does change, just make sure to mark that point in time with the value at that time, so that you can, do things honestly and ethically. Do it right so that you can just avoid trouble later, because the penalties for going back, we know some investors that have actually had that happen where they were reassessed years later. The penalties and interest is assigned from when the money would have been due. So, 5 years later, they get assessed this $100,000. Well, now they have interest on that $100,000 over the last 5 years, and they have penalties on it for, claiming wrong. Don't play. It's just not worth it. So what is the next thing? So how many of you guys can tell me what a straw buyer is? What's a hay buyer?
Heard of that?
Just say yes or no. Okay, do you know what a straw buyer is or a hay buyer?
A lot of times we'll see a headline in the news. Somebody is charged as a straw buyer, or somebody is fined. That it's a bad thing.
Yeah.
Okay.
Okay. So here's a story. As you guys are answering, it's straw buyer, hay buyer. As you're answering, let me tell you, one of my first deals that we almost bought, it was just too good to be true, one of those things. So I see this ad in the paper, in the newspaper. It says like assumable mortgage, no qualifying, all this stuff. So I go.
Not too many people have heard this term.
Not too many have heard of it. Okay, so it will come back. It's already starting. I can feel it, I can see it, I've been hearing about it a little bit. You're gonna hear it. Here's the deal with that. I went to see this place. It was beautiful. It was brand new. It was gorgeous. It was awesome deal. It was under market. Plus I could assume the mortgage without qualifying. It was like no money down, all this stuff. And I'm just like, hey, what's wrong with this scenario? I was like, something's wrong here. I'm out. Like, I just knew. I met these two guys, just seemed sketchy. Got out of there, forget it, not buying this place. It was one of our first opportunities that we could actually have bought. So, and I mean, that's after probably a year of trying and looking and whatever. And so it was really hard to walk away, but something wasn't right. So they called me back like 3 months later and they said, hey, we have a proposal for you. Can you qualify for mortgage? And I'm like, I think so. I don't know though. I don't know. And they're like, okay, how about this? We're going to pay you $5,000. All you have to do is qualify for the mortgage. And, you know, we will take care of the property, the rental. You don't get any equity or anything like that, but we'll pay you $5,000 just to sign on the dotted line. We'll do that for 2 years. And in 2 years, we'll take you off the mortgage. We'll get a new mortgage on it and you're out and you've made $5,000. And I was like, is that legal? And they were like, 100%. Absolutely. It's legal. Of course it is. I was like, well, that's not a bad deal right now. I could really use $5,000. So guess what? That's what a straw buyer is. That's what a hay buyer is. And I've been seeing it again lately, even on posts on Facebook, not only for opportunities, but also in like forums, people asking questions. So the deal is that they will say to you, we will pay you a dollar value to qualify on a mortgage. Now, that's the difference between whether it's legal or not. That is fraud. You can be charged with fraud for doing that. Guess what? They don't get charged with fraud. The guys that convince you to do this. You get charged with fraud. That is not legal. A dollar value. Okay, let's repeat this. A dollar value to qualify on the mortgage.
So let's say you want to buy a property. You can't qualify.
Right. So I say I'll pay you $5,000.
I don't have the money, but I can qualify.
People are saying I'll pay you $15,000.
Okay.
Yeah.
So you're going to give me $15,000 for me to go into the bank, put a mortgage on this property. I walk away. It's your property, and I get $15,000 for qualifying for the mortgage to use my credit, to use what I've built up over the years. So I would be considered a straw buyer if I was the one to put a mortgage on a property and I have no equity in it. Correct? So I'm correct. I wanted her to say yes, but I'm correct. This never happens, guys. Here we go. Okay, so here's a definition of a straw buyer, okay? A person who buys something on behalf of another person in order to circumvent legal restrictions or enable fraud. Okay, so here's the key in this whole scenario. I can now qualify for that mortgage for her if I get an equity share in the property.
Yeah, like Tisha
if
said.
I become part owner, 100% okay.
Now, can that be 1%, 2%, 5%? I believe it could be. You probably wouldn't agree at that point. But is it standard to be a 10% owner or a 15% owner in order to qualify on that mortgage? Absolutely. That's pretty normal and pretty good offer. However, this is the difference, very clear difference, and maybe you already reviewed this, I'm sorry. But the very clear difference is...
I might as well just go sit in another room. Like, what's the point of me being here?
Okay, you did that to me a couple of weeks ago, too. You were like, sorry, I'm not paying attention. That was actually in a laser session, actually. So, but anyways, he did it to me, too. But, so the very clear distinction is, are you being paid a dollar sum, or are you an owner in the property? If you're an owner in the property, yeah, you can qualify on the mortgage. Yeah. And that's legal. It's no ethical, no problem, no fraud. Every bank is fine with that. Where they are not fine with it is where you are not an owner in the property. You have no interest in the property, beneficial interest in the property. You're just being paid a fee, okay?
Straw buying is when an individual makes a purchase on behalf of someone who otherwise would be unable to make the purchase. And this purchaser has no intention of using or controlling the purchased item. So in our case, real estate, if I'm getting no equity in the property, if I'm not controlling that property,
no benefits,
then that's considered straw buying. If I'm just getting paid a check for qualifying for a mortgage, that's considered mortgage fraud. That's considered straw buying. So that's what we want to stay away from, guys. So now, if you're going to qualify for a mortgage because you have that ability and somebody offers you an equity stake in the property, absolutely fine. 100% okay. The problem is when you don't get an equity stake and you're just being paid a lump sum.
So that's the
difference.
So people have come to us and said, I heard it's illegal to just qualify on a mortgage. No, it's not illegal as long as you have an equity stake. It's illegal only if you're paid. So here's the deal. Guess what? Yeah, it's actually illegal. Like, we're not just talking, oh, it's gray area. No, that's
that's
black.
going to jail.
That's black.
Yeah.
Okay? It is fraud. Fraud. Mortgage. Fraud.
Say it one more time.
Fraud.
Okay. Let's be clear on this. It's fraud, guys. Okay.
It's fraud.
So we don't want to be that person who qualifies for a mortgage and gets paid a check.
I'm seeing it more and more right now.
Make sure if you're going to do that, you have an equity stake in the property. Point number 3. Let's move on. Okay, so we're clear.
3.
We've done point number 1, point number 2. Let's
point
do
number
3.
3. So cash flow is just gravy. Someone just said that on a forum the other day that I was reading, and everyone's like, amen. And I'm like, heck no. Let me tell you. We started our investing 18 years ago on that basis. We'd been taught that from our, mentors. Cash flow is gravy. Great. What you really want is market appreciation. That's where the real money is. That's when you're making $100,000 in a year or whatever it is. Guess what? That almost sunk us, and it has sunk countless investors.
Okay.
Cash flow is not gravy. Cash flow is dinner. You need cash flow to survive. You cannot survive on gravy or dessert or whatever you want to call it. Okay? Cash flow is important. If you're in a market that is going up exponentially, that's awesome. I'm happy for you. But guess what? So are we. And guess what? It stops. And we've seen in the last 18 years that no matter what market you're in, does not matter the city you're in, the market, the area, the natural real estate cycle, the economics are not, it's a science. It's gonna hit, it's gonna go down. That's just life. If you're not cash flowing those properties and you don't time the market perfectly right, you're gonna lose your shirt.
Yeah.
And we've seen it happen many times.
So here's the deal. Let me clarify and put my 2 cents in there because, we don't always agree, right?
No, we don't.
Okay, so just to clarify here, in my opinion, appreciation is the real wealth maker. Absolutely. That's where you're really going to make wealth. When your properties go up in value, when you buy in a market where properties go up in value, your mortgage gets paid down. That's where the big lump sums come from.
But not fast appreciation.
The key in what Tiffany is talking about and where, cash flow is not that important. Don't worry about it. It's gravy. That is so true because if you don't have that cash flow, let's say COVID hits and rents go down in your particular market and now you're negative cash flow, and let's say you're a successful real estate investor and you've bought in 5 to 10 properties and now they're all $500 a month negative cash flow, that's a big chunk of money and that sinks people. So when you're buying property, do you need to make sure they cash flow? Absolutely. Is that where you're going to make the biggest chunk of money in real estate? No. You're going to make the biggest chunk of money in real estate when it goes up in value and your mortgage gets paid down.
Over time or quickly, doesn't matter.
The cash flow keeps you in long enough, and that's really the key to all of that.
So that's at the end of the day what we've seen. We have seen more investors come and go in our 18 years. They do so great. They build their portfolios quickly. They buy. They do so good. And 5 years down the road, they're no longer in the game. And they're back to their 9-to-5 jobs, and they're back to, not living the life of their dreams because they bought based on equity appreciation. And that appreciation is awesome when it's there.
Well, we did too, right?
We did too.
Yeah.
We were one of those casualties of it, but for some reason we're still standing and we were able to work through that. But let me tell you, we bought on the fact that, it's just minus $50 a month. We can handle that. We've got another business. It pays for it. It's not a big deal. It's just minus $50. It's just minus $100. It's just minus 50. It's just break even. Well, guess what? When you get to having 25 of those properties and then the market stalls, you're in trouble. You're now paying out of pocket every month to support this portfolio. We've done it. But we've also seen many who have done it that didn't make it through.
Yeah.
And that's what we're talking about, guys. If you want to be successful, and this is for those of you guys, Simon and Melanie and all you guys that are around, have been with us for a long time, we preach big time about staying long in the market. Your mortgage has to get paid down by your tenants. The market has to naturally appreciate, maybe fast, maybe slow. You have to give time for those things to happen. So if you're not cash flowing, guess what? You will be stressed out beyond words. Every vacancy, every scratch on the wall that your tenants make, every repair that comes up, you will be stressed out and you will quit this game far before wealth actually kicks in. So what's the absolute deal? Cash flow is not gravy. It's bread and butter. You have to be cash flowing. It doesn't have to be a ton. You have to be cash flowing in order to last in this game, because you need to last those years in order to really hit wealth.
And I would suggest, if you're ever looking at a property, and right now, guys, the market is, in most parts of Canada, most parts of the world, the market has dropped, it's dipped a little bit, it's struggling a little bit. If you're able to cash flow in the market that we're in now, of course, there's markets that are doing phenomenal, so don't get me wrong. But if you're in a struggling market and you're able to cash flow now, Sam made a good point. Imagine when the market comes back. Imagine when the things go up. You're going to cash flow dramatically. So that's the key. If you can cash flow, just make sure you are. Make sure you can at least survive that cash flow going down 10 to 20%. If your rents dip 10 to 20%,
or you get a vacancy
and you can still cash flow, or then you're going to be you're most likely going to be much safer in that scenario. So very important point. Make sure that you cash flow. That's what keeps you in long term. That's what enables you to be there long enough for that property to go up in value. Remember, it's not about making money off of that cash flow necessarily. It's about enabling you to stay in long enough. That's the important part.
And why does cash flow help you do that? Is because it keeps the emotions out. And as investors, it's real tough to keep your emotions out when you've got, $2,000 payment coming out of your bank account and no rent coming in that month. And now that means you have to work later, longer, skip a vacation, take from your kids' school funds, whatever it might be. That's where things hit you, emotion kicks in, and that's where we really see people drop out. And when you drop out of real estate too soon, you really lose out, because it's in the long term that things kick in. So that is our rent on number 3. Cash flow is
point number 4. Point number 4, guys. What is it?
It's all about RSPs. So RSPs, for those of you that are a little bit newer, we've heard all kinds of, the gamut of whether or not RSPs can be used, can't be used. Is it for your primary house? Is it for rental properties? All this stuff. What I really want to clarify is that, first off, you never sell your RSPs in order to buy real estate. Well, not never. I should clarify that. Not never. But for most people, the smarter financial move would be to not sell them, because
when you say sell RSPs, what do you mean?
Well, get rid of them, cash them out.
Okay, so take them out of the registered plan.
Out of the registered plan.
Okay.
Yes.
Okay.
And at that point, you would pay taxes on them. Whatever tax bracket you're in, you would pay that tax amount on them. So that's a big hit in your investment. People say, "Oh, I'm taking my RSPs out so that I can, put that money in real estate instead." There is a way to take that money out, but not sell it and trigger a tax event. Just transfer it.
I think sell might be the wrong word.
Sorry,
because when you take RSPs out of the registered plan, you're not selling them necessarily. What you're doing is just putting them in. You're cashing out. That's a better term.
You're selling the stocks or mutuals that it's associated with, aren't you? No? Yeah.
If they're in stocks or mutuals, I suppose.
I guess. Yeah, that's true. Okay, so cashing out your RSPs, triggering a tax event, and then taking that money after you've paid the tax on it and taken a hit there and putting it into real estate. Not necessary. So you can just transfer them from, let's say, an institution that has them in stocks and mutual funds that are calling it self-directed, and move it to an institution that actually allows you to self-direct. Self-direct means I get to see where my money goes. Mm-hmm. And I am going to say that I'm going to put them into mortgages, whether that's firsts or seconds, whatever it might be. I'm going to put my RSPs into mortgages, which is an approved investment for RSP funds. And you do not have to trigger a tax event. You do not have to pay the tax on it. Got it?
So what's the whole point, what we're talking about here when it comes to RRSPs? The point is a lot of people think, number one, that they need to cash out their RRSPs, pay the taxes on it. So let's say I have 100,000, okay? And I'm in the 25% or so tax bracket. I have to take my 100,000 out, pay 25,000 to the government. I now have 75,000. Now I can invest that in real estate. Okay. That is not the case. What you can do is you can keep your 100,000, take it out of wherever you have it, your BMO, your Royal Bank, your TD.
Transfer.
So you transfer to a trust company and it stays sheltered. It stays registered and you don't have to pay any taxes. And now you can direct that to real estate when it comes to being a lender. You become a bank. You become a mortgagor, so that you can lend that to other investors. So and make an interest rate. So you don't have to pay tax on your RRSP money to use it in real estate.
Oh, secondly, self-directed is a term that is used across the banking industry as well. But this is what they mean by it. A bank will say, oh yeah, you can self-direct your RSPs. You tell us where, we're not going to tell you where to put your money. You tell us where you want it. You can either put it in number 1 investment that we own, number 2 investment that we own, number 3 investment that we own, number 4 investment that we own, or number 5 investment. You decide. It's self-directed. That is not a true self-directed RSP account. Olympia Trust, there's quite a few, but Olympia is probably the one that we use the most. So self-directed, real self-directed, if you're going to move off, the real self-directed is moving it to like a trust company, Canadian Western, Olympia, whatever it might be.
You put it wherever you want.
And then you get to choose, including putting it into mortgages. Okay, so that's how you can invest your money.
Or like Colin says, land developments, private lending, syndicated mortgages, REITs, all of those types of things, exactly.
And that's whether you have it, like Marie said, in a LIRA or in an RSP or an what do you call it, TFSA.
The key to all of this, though, is when you do that, like Melanie said, you can't lend it onto a property that you have an interest in. So it has to be arm's length, which means it's somebody you're not related to and not yourself, one of your own properties or a property of somebody you're related to. So you have to lend it arm's length. Okay, so that's just to clarify when it comes to RSPs.
Tammy has a really good question. Can I do it through a trust like Olympia directly, or do I need to use a mortgage broker? Tammy, you can do it directly. So if you, for example, if you are using Olympia Trust, you can just Google them, go on their website, and then there's self-directed. There's a tab for self-directed RSPs, and it has 5 forms. You fill out those forms, you transfer your account over. It's actually really easy. It seems complicated at first, then you print out the forms and you're like, oh, okay, I kind of know all the answers to these things. And yeah, you can direct it yourself, and then you need to find someone that you want to lend it to. And that's how you then say, like, Corey and Tiffany, you're looking for RSP funds. I've got, 50 grand. I'm looking for 6% interest or 8% interest or whatever it might be. What do you have to offer right now? All right.
Okay, so that was point number 4, RRSPs, and that you have to pay taxes. Some people think you have to pay your taxes on that when you take it out if you want to invest it in real estate. That is not true. That is a myth that is incorrect. We wanted to clarify that today.
Point, okay, number 5. So our 5th point for tonight is, at times in the past, there pretty much, if someone lent you money to buy real estate in a second mortgage position, they would expect that you're going to pay them, 10, 12, maybe up to 15%, depending on the situation. That was the standard. It was like, you get a second mortgage from someone, RSP funds or just straight up cash, you're going to pay them 12%. That's not the culture right now. Will it change back? Probably. But right now, there's a few things that have happened in the last couple of years. So first of all, interest rates are at all-time lows. We're paying our banks 1.5% in some cases. So, where we used to pay them 6%, we're now paying them 1%. Well, our second mortgage lenders too used to get 12%. They're not getting 12% anymore. You can offer them 8%, 6%, 5%. You can offer them bank rates 3%. And that is becoming the industry standard. So don't think that if you get a second mortgage, if you find it yourself. If you're going through a broker, yeah, there's extra fees to pay. So yeah, if you find lenders yourselves that have RSPs, they want to place it, can you offer them less than 10 and 12%? Yes, absolutely you can. So, especially in non-investing worlds. Us as investors, we're like, wait, no, I want my 12%. I know I can get it, I'm going to get it. Yeah.
Here's the big picture view, guys. Think about this. How many people have RRSPs? Quite a few. How many people have RRSPs that aren't doing well right now?
That they've lost even
quite a few.
30%.
How many people have RRSPs that are negative something percent because their stocks or funds or whatever they have invested in are going down in value? Quite a few. How many people who have RRSPs do you think would jump on something where it's secured against a physical piece of real estate at a good loan to value ratio and get a guaranteed 6, 7, 8% return on their money? A lot of people. So change your thinking when it comes to second mortgages. Change your thinking when it comes to pulling money out of a property, using some of that equity to now go and buy another property, or to do a renovation, or to flip something, or to do something that is going to create more money in your bank account. Okay, so if you can pay 6%, 7%, 8% in a year, so let's say I take 100 grand out of my property, okay, and I pay 8% interest. I'm paying $8,000 on that money. Now, if I buy a property and I put 100 grand down because that's what I'm using it for, and it cash flows $500 a month, and my mortgage is paid down $15,000 that year, and it goes up 1%, let's say it's worth 300 grand, it goes up 3 grand. That property increased in value by 20,000, but I paid 8,000 in interest. Is that going to make sense for me? Yes, it does. So are there people that out there are going to be happy getting 6, 7, 8% interest on their RRSP money or any of their money? Absolutely. There's lots of people out there right now. So this comes back down to really just having those conversations. We talk about that all the time. Increasing your network, putting it out there that this is something you're looking for. Or if you're a person with RRSPs and you want to have something guaranteed, put it out there saying, hey guys, I have RRSPs available to lend on property. And if you do, it works great both ways.
In our investor world, we know that the options are out there to make more money. So is it going to be a little bit tougher to offer, a lower percentage to some of your lenders? Absolutely, it's going to be a little tougher. But there are so many people in our world, in our life, that have RSPs that are not working for them, that I feel that we actually have a responsibility to let them know that there are better options. And if you're paying them 5% on their money, and that's a win for you and your property can sustain that, and it's a win for them at 5% when they were getting, 1% or 0 or under, or losing 30% in 1 month of their whole portfolio, that's a pretty good offer for them. So this means often going outside of the investor world and looking in other circles, but even within the investor world. So you can absolutely do that. And Paula says, it breaks my heart watching my parents' RSPs, how hard they worked for that money.
Yeah.
And in COVID, 30% of it gone. In the tech bubble, 30% of it gone. No, 50% of it gone. So volatile. This is land they have a caveat or a lien against. The security, and right now with the fear that's out there, we can really offer people an awesome place to put their money, a safe place. And people are looking for that. So they're not so concerned with the interest rate. Danielle, you asked, how long before you can ask for an RSP on a property? It really is dependent on how much equity you have, because you don't want to over leverage that property. So, if you've got a place that's, already leveraged up to 80%, maybe you're good. If you've got a place that, has a mortgage of whatever, I'm just going to use easy numbers. If it's worth 100 grand.
Tiffany and numbers.
If it's worth 100 grand and you only have a $60,000 mortgage on it, can you pull out another 20 and bring it to an 80% LTV or even higher? But that, don't go too high because that gets a little riskier. I like to stay around that, even 75% mark. So that's when you know that you can afford to take out a second mortgage on your place. Anyways, okay, so those are our 5 points. Let's quickly review. Number 1, CRA.
There is no time frame. There is no 6 month or 1 year limit. You have to live in it, be able to flip it or anything like that. It all comes down to your intention.
And the key is establishing that date where there was a change of use from it, if you do, change it, and establishing the value at that point, so that you always have backup if CRA ever comes knocking.
Yeah.
Number 2, what is fraud, hun?
Straw buyer, hay buyer. Absolutely.
What makes it not fraud?
What makes it not fraud is if you have an equity stake in the property.
There you go.
If you don't have an equity stake and somebody is offering you a check to qualify for a mortgage, run, guys. Mortgage fraud.
Yeah.
Point number 3.
Run. Cash flow is super important. It's the longevity in this game. If you don't have cash flow, you will not make it in this game long term. So huge. Don't buy just on equity appreciation, the promise of it, the speculation of it, whatever it might be. Make sure that your properties are cash flowing. And does that mean you can't buy as many sometimes and it takes you longer to find them? Yeah, it does. But does that mean you're going to stand in this game for 20 years instead of for 5? Which one do you want? Trust me, you want the 20. So cash flow is not gravy.
King.
It's king,
yes.
Yeah.
Number 4, RRSPs. You do not have to pay taxes on them when you take them out to invest in real estate. You can transfer them from your current bank to a trust company tax-free. There's no tax implication that's taken in that particular scenario. You can direct them towards real estate. Of course, it's real estate you don't own or your family doesn't own, but you can direct it towards real estate. Nothing is guaranteed. Let's be clear on that. But you can get a fixed interest rate on a second mortgage. You can invest in land development. You can invest in so many different things if you have it in a true self-directed account with a trust company versus what a bank considers a self-directed account.
Awesome. So don't pay tax by cashing out your RSPs.
Yes.
Okay?
That's myth number 4. Number 5.
5 is that you have to pay high interest rates to private lenders. So right now we're talking, this may change again because it does. Everything changes. It changes so often. But right now, between COVID and the people losing their, a lot of their percentage of their portfolios, as well as the fact that we're at an all-time low for interest rates, people do not expect the high rates that we have been used to paying as investors. So can you borrow private money expecting to pay a little bit less of a rate? Absolutely. So for those of you that have thought, I'm not paying 12%, my properties don't support that, I can't even look down that, rabbit hole, you might want to start looking at it again because, the myth that's out there is that it's a 10 to 12 to 15% range, but that's not happening right now. So Sean
asked, when it comes to straw buying, what if you have both for straw? So somebody pays you a check and then somebody also gives you equity at the same time. I think that would probably be fine. The point is as long as you have equity in the property, as long as you have an ownership in that property, as long as you are actively have a beneficial interest in that property, then whether you take the cash flow and somebody else doesn't, or whether you do or you don't and somebody else does, all of that stuff doesn't really matter. The point is that you have to have a beneficial interest in that property versus just somebody writing a check. Good. There we go, guys. There's the myths that we were going to talk about today. Today was myth busting. Some of the things that people think out there that are common, that we hear all the time, and it's just absolutely not true. We wanted to clarify some of them today.
And lastly, ignited consults. If you guys want to, move to the next level, you want to jump up your game, and you want to, move faster, scale bigger. We do have a mentorship program, a coaching program. A lot of people are like, oh, we didn't know. Why didn't you tell us? So we're going to start to try to remember to say this more often. So I wrote a note. If you want to know, about our coaching program, you can go to our website, investorlife.com, and you can set yourself up for a consult, and where you sit down and you talk with Corey for half an hour and figure out, listen, where are you at, and does this help? Can we help you? If we can't, we will tell you. We will not. Your success is our success. We will not be successful if we're taking people's money and not making them successful. So
Investor Life, guys, not Investor Live. Investorlife.com.
Sorry, Investor Life.
All right, take care, guys.